Hey guys, hope you're doing well out there. Today we're taking a look at two names that have recently undergone a CEO transition, also are trying to get back on the right track after a couple of rough years, and very significant missteps in their businesses have caused shares to plummet over the past couple of years. That is the Boeing company along with Starbucks Corporation. Each of these reported their earnings yesterday. We'll take a look at it from an earnings perspective, a revenue, cash flow, all the important things we like to look at and see whether you can maybe start beginning to outperform not just the broader based S&P 500, but also other peers in their own sector. So we'll put those earnings into perspective for you. We'll also take a look at it from a trading perspective. Maybe there isn't opportunity to go long these names quite yet, but that doesn't mean there isn't money to be made in these names. We might take a look at it from a short-term perspective and highlight some levels where you could look to maybe swing trade these names. As always, I will have timestamps in the description below for each of these companies, so feel free to jump around to the name that interests you the most. As always, if you're also new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Kicking things off with the Boeing company, after reporting their earnings, shares saw a rally of close to 1.5%. Now, over the past 1 year, you've lost nearly 13%, and over the past 5 years, you're down close to 43% if you've held shares of Boeing over that time period. So certainly a 1.5% gain isn't really doing much for your portfolio. Now, we'll also take a look at their Q4 results, which came out again yesterday. Top line revenues declined nearly 30% year over year, down to $15.24 billion. Keep in mind though, that was still a beat of close to $60 million. So you're probably wondering, why are shares up close to 1.5% after they reported a revenue decline of nearly 30%? Well, that's because everything comes into context of expectations, and expectations for Boeing are certainly on the floor. They're basically grounded like the 737 Maxes that you have over at Boeing. The expectations really haven't been lower, and so even though you're posting revenue declines of close to 30%, those are still beating those expectations, and well, yeah, that's always a good sign. Where you didn't meet those expectations, in fact, where you significantly undercame those expectations, is on the non-GAAP earnings side, as you came in with a non-GAAP earnings loss of nearly $5.90 that missed estimates close to $2.67. So that is a huge miss on the earnings side. Now, as we go over their earnings, you'll see it's pretty apparent why they lost nearly $6 per share on a bottom line. But first things first, let's take a look ahead into what's expected for the upcoming few quarters over at Boeing. If you take a look at expectations for fiscal 2025, you're expecting nearly mid to call it low teens growth on the revenue side. It's when you get into Q4 of 2025, basically a year from now, is when you're expecting significant ramp up on those revenues, up nearly 46% year over year. But again, that quarter would be lapping the quarter that we just posted, where you saw revenues declining by nearly 30%. So despite seeing this 46% gain on revenue potentially next year, keep in mind it's coming off of a very low base, and again, very low expectation. The other thing I want you to keep in mind is you have just one analyst here on Seeking Alpha making these expectations. So take this with a grain of salt. You probably have a pretty wide variance in these estimates, considering the fact if you have more analysts probably come in here, make predictions closer to their Q1 report. In terms of the earnings expectations for the next fiscal year, keep in mind this company certainly lost money in fiscal 2024. They, I believe, also lost money in fiscal 2023, and they're expected to continue to post a negative earnings per share in fiscal 2025. And so that's why you don't have a forward priced earnings multiple on this. If you take a look at Seeking Alpha, you can't find a forward priced earnings multiple. That's because they won't be profitable even in 2025. You have to look all the way out to 2026, where this company will begin to eke out profitability. And even then, it's not meaningful profitability. You're looking at roughly 2026 full year earnings per share estimates close to $5, even as high as maybe $5.50. And for a stock that's still at nearly $177, you do the priced earnings math on that, you're looking at close to 35, even 40 times a 2026, that's right, 2026 earnings multiple. So Boeing, despite the decline in share price over the past 5 years, down 43%, shares certainly aren't cheap, considering the fact that earnings are still a long way out, at least meaningful earnings, you're probably not seeing until 2027. So keep that in mind. All of that comes with a grain of salt. Now, Boeing in particular has 3 different business segments. The first one, and the most important, is the commercial airplanes. The second one we'll take a look at is the defense, space, and security. And then the last segment is global services. But the one I really want to pay attention to is commercial airplanes. This is their most important segment, in my opinion. It's also their largest from a revenue perspective. And look, these are the commercial planes that you and I travel on. And needless to say, this is where, in my opinion, Boeing has had the biggest missteps and their biggest scrutinies. Now, you see, in 2023, Q4 revenues were nearly $10.5 billion. Well, that looks decent. It actually wasn't great even compared to 2022. But what's even worse is in Q4 of 2024, this most recent quarter, you posted less than half of that in your top line revenues for your commercial airplane segment, underneath $5 billion in quarterly revenues for commercial airplanes. What's even worse is you pretty much have no leverage on this business. Anytime you see revenues decline, your operating margins pretty much follow in line, as you had basically no operating margins last year. And now with revenues declining 50%, those operating margins are also declining close to 50%, as you have negative 43% operating margins in this business segment. Now, they describe a few reasons why. Firstly, this results reflect the previous announced impacts of the IAM work stoppage and agreement. So that's the first thing I want to talk about. The International Association of Machinists and Aerospace Workers, which is the IAM union workers, they achieved a new contract victory to set standards for the aerospace industry. So if you weren't keeping along with Boeing over the past couple of months, I believe sometime in September, you had roughly 33,000 frontline workers over at Boeing that are part of this union. They went on strike to demand higher wages, to demand better working conditions, I believe to demand other things such as better healthcare, better security provisions and overtime rules, and better 401k matches, and a whole bunch of things. And so these 33,000 Boeing workers went on strike and basically halted the production of 737 MAXs coming out of Boeing's facilities. Now, what you had is that strike continued on for nearly 2 months, and early in November, Boeing got onto an agreement with the workers that were striking, and now will deliver a nearly 43, close to 44% compounded wage increase for these 33,000 frontline workers over the next 4 years. So next year, you'll see a 13% bump up in their wage, and then every subsequent year, you'll see roughly a 10% bump up in their wages, which compounds to close to 44% over the course of 4 years. Now, for the union workers, this is an absolute win. Look, anytime workers are able to demand more wages, anytime they're able to get more benefits such as a 401k match, better healthcare, better disability plans, better security, all of those things for a worker are absolutely phenomenal. And especially workers over at Boeing that are so critical to this company, so critical to the products this company makes. Yeah, the working conditions for those people should absolutely be better, and certainly their wages probably should also go up. Now, that's from the perspective of the worker. At the same time, though, you have the perspective of Boeing, which is putting up stinkers of results with revenues down 50% and operating margins down 50% as well. So now the fact that you have to consider workers' wage going up close to 44% over the next 4 years, that is absolutely going to squeeze Boeing even further. For a company that's already struggling to manage costs and the runaway expenses, the fact that they'll have to pay out nearly 44% more in wage increase over the next 4 years, which, keep in mind, is far ahead of inflation over the next 4 years. Yeah, that'll extremely be tough for Boeing to do and continue to squeeze this company from an operating perspective. And so keep in mind, the operating margin profile for this company likely won't get much better over the next, call it at least 1 year, in my opinion. And so in particular, this quarter was extremely rough simply because you had that stoppage in 737 MAX production for roughly 2 months out of the quarter, and early in November, that agreement came to terms, and then 737 program resumed production. Now, they are planning to increase that production gradually over the course of the next couple of years, but what I want to point out is over the last 3 months, this company delivered just 36 737 MAX commercial airplanes. Again, over the past 3 months, that's not a lot of airplanes, especially compared to same time last year where you delivered close to 110. And just for the last 3 months altogether, you delivered 57 airplanes on the commercial side, whereas last year you delivered close to 157. So certainly the struggles over at Boeing, not just from a safety perspective where the FAA is grounding flights, but also from a worker perspective where the workers have so much leverage over at this company that, yeah, if they all choose to strike, Boeing really has no option, and they have to give in to those worker demands. And well, that can absolutely hurt profitability, not just in the short term like we just saw, but also probably over the next few years. So keep that in mind. Now, they did mention that over the next couple of years, Boeing has an absolute ton in backlog demand, as they have nearly $435 billion in backlog just on the commercial airplane side. That is close to 5,500 airplanes. And I don't know, last week, if you got a chance to check out earnings from airline companies, but earnings from companies like Delta, United, along with American Airlines, travel is certainly booming, and these airlines are taking advantage of that. Now, you did have Delta CEO saying that they are confident about moving forward with the order of their Boeing 737 MAX 10s. And so certainly these airline companies are relying on Boeing to come in and deliver those aircrafts that they have promised. It's just if Boeing can get its act together, they could actually deliver this nearly $400 billion backlog of close to 5,500 airplanes, and that can certainly help improve profitability over at this company. It's just if they're able to get out of their way and produce a safe plane with FAA approval, then yeah, this company certainly has a path towards profitability considering the backlog they have. You also had comments from the CEO of Delta Airlines saying that we certainly will not take them, and them referring to Boeing 737 MAXs, till we have 1,000% confidence that the plane is fully secure, fully safe, and everyone has signed off to that. So certainly Boeing has this reputation, not just to the general public, but also to regulators, also to other airline companies, that look, these planes absolutely have to be certified safe 1,000%. Only then are we taking deliveries of these aircrafts, because certainly we don't want any more tragic incidents. And so that's really what puts Boeing in a tough spot, is because they're trying to produce these planes, they have a ton in backlog, but the safety concerns keep popping up time and time again. Now, from the defense, space, and security perspective, this segment also saw a decline in revenues year over year, as you went from 6.7 billion down to 5.4 billion. You also saw a decline in your operating margins, which was negative last year. So even despite higher revenue last year, you weren't still making money from an operating perspective. And this year, after declining on your revenues, your operating margins pretty much fell apart, down close to 50%. You also have a backlog on this defense and security business to the tune of close to $64 billion. The one bright spot remains global services, as you saw an uptick in revenues just modestly from 4.8 up to 5.1 billion. You also saw an uptick in your operating margins there, and you still have a backlog on the global services business as well. But all in all, I think the commercial airplanes business is really what is hampering this company. And if they can begin to deliver these planes to their promised customers, to airlines, not just here in North America, but it's also especially airlines in Asia that are seeing a huge demand in travel and have huge orders for new planes, then yeah, this revenue profile and the operating margin profile certainly could maybe look to turn around some point down the road. But from this quarter, it was an absolute smoking hot disaster. Now, if that didn't give you the full picture, the first two lines here on the statement of P&L should pretty much tell you the full story over at Boeing and pretty much how 2024 went. You had $66.5 billion in full year revenues. That was down from roughly $77 billion same time last year. And you come down to your cost and expenses. Again, this is just on the cost of goods sold, really on the cost of manufacturing those planes. That came at $68.5 billion. So you sold your airplanes for nearly $66.5 billion, but it cost you close to $68.5 billion to actually make them. And again, that doesn't even consider any of your G&A costs, any of your R&D costs, any of your employees, really anything else. So you're actually having negative gross margins over at Boeing throughout the course of 2024. Again, that's negative gross margins. Forget operating margins. This company has negative gross margins over in 2024. Even from the most recent quarter, your gross margins are negative because your costs to make these planes came in higher than your actual revenues for the quarter. So an absolute disaster. On top of that, you still have G&A expenses to the tune of $5 billion for the year, another $3.8 billion in R&D. In my opinion, I think the G&A costs are frankly far too high over at Boeing. You probably have a lot of people wearing a lot of fancy suits that frankly need to walk out the door or take a pay cut, and you probably don't have enough engineers over at Boeing, considering the fact that you have safety and R&D concerns propping up all the time. So in my opinion, Boeing should look to spend probably more on R&D and actually less on G&A. Frankly, to its core, it is an engineering company that should look to spend more on safety initiatives and R&D initiatives. And you come down to your operating loss close to $11 billion for the year. In the quarter, you lost nearly $4 billion. So all things considered, it was an absolute disaster of a quarter over at Boeing. From an earnings per share perspective, lost nearly $5.50 on a diluted basis. The other thing I want to point out is your shares outstanding went from roughly 600 million shares, now close to 718 million shares. That's just over the past 1 year. So that's not something we can gloss over. This is a very mature company that is now starting to dilute you very significantly. And when we get to the cash flows, you'll see just exactly where, and more importantly, why they had to raise this cash as we look at their balance sheet. Now, from their balance sheet, you see their current assets, their cash and cash equivalents sitting at roughly $13.8 billion. The short-term investments went from $3.2 billion, call it, up to $12.5 billion. So that capital they raised through equity dilution looks like it's showing up here on the short-term and other investments line. You see the inventories over at this company continue to tick up from 80 billion up to, call it, 87.5 billion. So they certainly do have those planes sitting in backlog. They've had those planes already produced. They just need to be able to deliver those once they get regulatory approval. From a liability side, this is where things get still uglier over at Boeing. You have close to $52.5 billion of long-term debt, another $1.2 billion in short-term debt. So this company is sitting on close to $53 billion of total debt and just about, call it now, $26 billion in cash and cash equivalents. Keep in mind, a lot of that cash was raised through an equity offering, simply because if they didn't raise that cash, to be honest, their credit rating from a company like S&P or Moody's would actually probably drop below investment grade. And anytime your credit rating drops below investment grade, the cost of capital would be significantly higher. And so if Boeing didn't actually raise that capital through equity dilution, they would have to pay a lot more in interest than they already currently do. And so that raising of capital certainly was a good thing. It allowed them to maintain that credit rating, I believe, which is at a BBB for this company, but at least it's above an investment grade rating. Now, from a cash flow perspective, you come down to operating cash flows that bled through nearly $12 billion in operating cash flows over the past 12 months. Now, this company is pretty capital intensive, and so they do spend nearly $2.3 billion to acquire property, plant, and equipment. So your free cash flow was close to negative $14 billion for the full year. And so we come down to the financing activities, and we see that nearly $18 billion common stock issuance, that is the capital they raised through diluting you if you own shares of Boeing. And they also look to refinance some of their current existing debt, it seems. So all things being considered, disastrous quarter over at Boeing, really disastrous year over at Boeing. Anytime you see you have negative gross margins for the full year, pretty much paints you the full story that it was an absolutely kitchen sink of a year over at this company. Now, as you look ahead, really the upside is if Boeing can come in with better than anticipated results, maybe if they get approval for those airplanes and they can begin to deliver those to customers rather quickly, that could be positive upside for this company. That is something we'll have to wait and see. Certainly there's events and catalysts that could send shares lower if perhaps more tragic events occur or if further delays occur in terms of production for 737 MAX, then the struggle certainly will continue over at Boeing. Now, from a technical perspective, we basically have marked out this range down to basically $140. That's where you have a fair amount of support. You've bounced off that level a couple of times in the past, and you have some meaningful resistance up here at $240. So you're looking at basically $100 range. And I actually would look to play the swings in shares of Boeing within this range rather than holding it for a long-term perspective. Look, there's enough fundamental risk with shares of Boeing, with this company, that makes me want to stay out of it from a long-term perspective. But there are significant amounts of ups and downs that the price action has that you could look to maybe play the upside. Now, whenever you look to play an upside like this with shares of Boeing, you would absolutely need to set a trailing stop loss. That's because if you continue to move higher, you want to lock in more and more profits. And if you see a sudden sharp downturn, then your stop loss should absolutely get hit, because you could come back down to the bottom end of this range, down to the 140s in a hurry. Keep in mind, you've made these rapid swings in shares of Boeing in the past. Certainly could happen again. This is very volatile in terms of the news stories that come out over at Boeing. And so from that perspective, if you're looking to get in and out of this name, a trailing stop loss, I would say, is an absolute must. Now, if you extend the timeline over a longer period of time over at Boeing, if you date all the way back to the 80s, you could actually make an argument that shares are in a technical uptrend over that time period. And if you come down to the 140s, you actually would also be coming down to a bottom end of a range where you could find some long-term uptrending support. So that is a level where I would keep an eye out for Boeing close to the 140s. If you come down there, you could maybe look to take a crack, at least from a swing perspective, considering the fact that you're at the bottom end of multiple ranges. And then from that perspective, look to a swing higher close to $240 a share. Again, set that trailing stop loss because you don't want to break down much further from there in the event of any further weakness in this name. That was my take on shares of Boeing. I think there's still lots of work to be done here. Despite the new CEO, I think there's enough problems this company has, and you never really know with Boeing. These stories could absolutely continue to get worse. And so for that reason, I'm staying out of this one for now because I think there's still too much unpredictability with this name. Now, moving on to Starbucks Corporation, which also has seen its fair share of struggle over the past couple of years, although hasn't been quite as bad as shares of Boeing. Over the past 1 year, you're up just 7%. Over the past 5 years, you're up close to just 13%, which again, compared to the S&P 500, which is up a whopping 85% over the past 5 years, yeah, you've significantly underperformed in shares of Starbucks. Now, one thing you do get with Starbucks is a 2.4% forward dividend, and so you certainly do have a reason to continue to hold on to shares if you are in this one. You also get a buyback with this one occasionally, at least over at Starbucks. So keep that in mind. A couple of reasons to continue to hold on to shares. From their most recent Q1, which came out, revenues came in at $9.4 billion. That was flat year over year for no growth, but did beat expectations close to $90 million. So similar to Boeing, the expectations over at Starbucks have continuously been revised lower and lower. And so you're coming into an earnings with relatively low expectations, and so pretty easily beatable over at Starbucks. From a GAAP EPS perspective, you came in with 69 cents. That was also a beat by close to 2 cents. Now, the key metrics over at Starbucks is the global comp store sales. So comp store sales, very important figure. It's basically if you take the same number of stores and you compare those year over year, the sales in those stores declined by roughly 4%, a very important metric really for any retailer. And that tells you a lot that you need to know. So 4% decline on your comp store sales, that was driven by 6% decline in the transactions. So that's basically the number of people buying a Starbucks drink, but again, offset by a little bit of an increase in your average ticket price. So in my opinion, this is actually a bit concerning because anytime you see a decline in transactions but an increase in ticket price, it tells you not as many people are visiting or at least purchasing your products, and the ones that are purchasing it are having to spend a bit more. And especially in a coffee market where the consumer is already complaining and a bit more squeezed in terms of prices, a 3% increase in average ticket price is probably due to the fact that Starbucks continues to go up on pricing really when it shouldn't. And you in fact have incoming CEO Brian Niccol, who said recently that Starbucks won't be going up on pricing further over the next year or so. So ideally, I think what Starbucks would really want is, of course, comp store sales to be increasing year over year, driven by mainly a higher percentage increase in comparable transactions. That should tell you that more and more people are entering the stores, more people are purchasing drinks, and then basically also see roughly flat to maybe modest growth in your average ticket price. You don't want to go up too much on your average ticket price. That tells you that Starbucks is going up on pricing way too much and way too fast. Now, in terms of the forward-looking quarters over at this company, we'll have this Q1 get revised considering that's the quarter that they just reported, but looking ahead to Q2 and beyond, you're expecting, call it mid to low single-digit growth on the revenue side, roughly around that $9 billion every single quarter for the rest of the year. When you get into 2026, you expect that growth to accelerate back into the high single digits on that revenue side. On your earnings story, looks pretty rough over at Starbucks as you're expecting earnings declining over at least the next few quarters at Starbucks. When you get into the back half of 2025 into Q4, you're seeing that earnings pick back up once again into the low to mid teens. It's really until 2026 is when the story begins to change over at Starbucks. A lot of their initiatives that they're taking now and over the past couple of months really will take some time to get into effect. This is a big ship that when you have to make those changes and make those transitions, they take a long time to actually show up in the financials in any meaningful way. So I anticipate another, call it 2 to 3, maybe even 4 quarters of tough sales growth and possibly even declining earnings growth over at Starbucks. It's really in 2026 is when you're hoping for the turnaround to to actually be visible through their results. Now, they have two main important segments. The first one being North America, which is by far, in my opinion, the most important segment for this company. And then you have the international segment as well. So on the North America side, you saw those comp store sales decline roughly 4%. The tickets, the transaction prices actually declined 8%. And then the average ticket price went up close to 4%. So that's what we were talking about. You saw lower volume move through the actual store, but higher prices, likely due to year-on-year price increases on the products. You also saw growth on the store count, close to 3%, and the new CEO did mention that they will look to slow down the store count growth and look to maybe renovate and remodel the existing stores more so rather than adding new ones. And then you see your operating margins and operating income actually declining substantially year on year. The one thing they did mention about operating margin, especially in North America, is that it was primarily driven by a deleverage and investment into the Back to Starbucks initiative, which including store partner wages, benefits, and hours, really telling you the baristas are probably going to get a wage bump and improved benefits and hours. Also, the removal of the extra charge for non-dairy milk customizations. I think that's a big thing. A lot of customers, I think, were tired and at least complaining on social media about having to continuously pay extra for non-dairy milk substitutions. And certainly if Starbucks is looking to get back to Starbucks, that is part of their initiative. So making the store a bit simpler, making the ordering process a bit simpler and a bit easier for the customer as well. In terms of the international segment, you saw declines there as well. Comp store sales declining 4%. In the all-important China region, comp store sales actually declined close to 6%. And similar story, you're seeing your operating income declining, operating margins declining, but nearly not as bad as you are seeing it in North America. They are taking more of a hit in North America. I think this is where their core audience is. You also get higher ticket prices here in North America compared to internationally. Now with Starbucks, you have a new CEO at the helm. That's Brian Niccol, who took his first full quarter over at Starbucks. He's coming over from Chipotle. He did a fantastic job turning around Chipotle, and prior to that, turned around Taco Bell as well. And so he certainly has the right experience in the quick service restaurant business to turn around a business that's at least struggling at the current time. And it's important to listen to his comments that he makes on the conference call. So he did say that Starbucks is focused on becoming a welcoming coffeehouse environment and returning to sustainable growth. He said that there's been positive early signs in the core business, including a shift into higher percentage of coffee-based and espresso drinks. He mentioned that in the coming months, Starbucks will optimize its menu offerings, resulting in roughly 30% reduction in total beverage and food items. So that's, again, similar to the earlier story we saw where they're reducing that extra charge for non-dairy substitutions. I think a big problem with Starbucks is simply there's too many choices right now. And what that does is for a barista is it makes it tough to actually make a drink rather quickly, simply because they're trying to make so many different drinks all at once. And so that reduces your level of customer experience that you get from the barista. The company also plans to deploy digital menu boards fully in the US and launch a pilot at roughly 700 stores that looks at staffing levels to optimize their baristas. Brian Niccol also did mention that he sees the potential to double the store count in the US, even though it's optimizing current store base and renovating some locations. And then Starbucks didn't issue formal guidance, but they did warn of higher G&A expense due to restructuring over the next, call it, year. So I think there's some good comments here. You're seeing that the management team is committed to restructuring the business, control some costs, especially on the G&A side. They're also looking to renovate some locations, so some of that CapEx will be spent in terms of renovations. They're also, I think the big thing is simplifying the menu over at Starbucks, which in my opinion is probably the biggest thing, because it helps the baristas produce those drinks rather quickly. And it's a similar thing to what Brian Niccol did over at Chipotle, which in my opinion worked wonders. Now, the other news you have that you have to pay attention to when you're taking a look at Starbucks is coffee prices, because certainly this company is absolutely dependent on a commodity like coffee prices, no different to how airlines are dependent on fuel prices. A company like Starbucks absolutely dependent on coffee futures. And if you take a look at the price of coffee over the past, call it even 50 years, it's never been higher. In fact, over the past 50 years, this is the highest coffee price we've seen on a per pound basis, and you're hitting those record highs. Now, I do anticipate these coffee prices to level out, I'd say somewhere in the $200, call it $250 per pound over time. But certainly at the current time, I think these coffee prices are absolutely elevated. And just over the past 1 month, they're up close to 11%. So a change like this is absolutely going to affect Starbucks, not in the most recent quarter, but probably in the couple of coming quarters ahead. And there's a few reasons why coffee prices are soaring. First of all, you have just US and Colombia trade tensions. You probably have the possibility of tariffs being added on to either side. And so Colombia is, I believe, the world's second or third largest producer of coffee. You also have a massive drought going on in Brazil, which I think affects coffee coming out of there. And then you, of course, have the Lunar New Year in Vietnam, currently halting production in that part of the world. So you certainly have a few reasons why coffee prices are soaring. I think a similar case is there for cocoa, as cocoa prices are also heating up and have been for a long time, which affects certainly chocolate makers out there. And so important to keep in mind commodity prices and how it affects a company like Starbucks. Now, from a P&L perspective, it seems to me the company is leveling out from certain aspects. So you see net revenues flat on a year-over-year basis. You didn't really see a huge decline on those revenues. Where you are seeing declines is on the margin and the operating income side, as this company still has relatively high expenses and they're not able to control those expenses, which grew at close to 4% year over year. So you saw that operating income decline by roughly 25%. You also saw contraction in your operating margin from 16% down to close to 12%. And similar story on your earnings side. From a balance sheet perspective, looking still relatively okay. You have close to $3.5 billion in cash and equivalents, another 1.7 roughly in inventories. You come down to the liability section and you see roughly $2.2 billion in stored value card liability. This is really the bank over at Starbucks. It's actually one of their big moats, I would say. There's not many other coffee companies out there that can basically have $2.2 billion deposited by customers from their Starbucks reward program onto the app and just have that sitting there. It allows them to do early investments and capex from that money that maybe other coffee chains out there couldn't, simply because they don't have a customer base that's willing to sort of spend that kind of money and deposit that onto the app. But with that comes also a fair amount of long-term debt on the liability side. You have close to $14.3 billion in long-term debt. I think this is something Starbucks will certainly look to control and reduce over the next few years with their free cash flow. I think reducing that long-term debt and bolstering on the balance sheet certainly should be top of priority for this company. From a cash flow perspective, you got nearly $2 billion in operating cash flows over the last 3 months. Still pretty decent, even though it was a decline from same time a year ago. You still have close to $2 billion in operating cash flows. This company having a fair amount of capex, considering the fact they're opening new stores, they're renovating existing stores. And so you have close to, call it $700 million in capex. And so you're looking at roughly $1.3 billion in free cash flow for the most recent time period. And they don't do a whole lot with that. They pay roughly $700 million in dividends, which you can continue to get over at Starbucks, continue to hold those shares for that dividend. You also get a bump up on those dividends every year. Then the rest of that cash they added onto their cash flows, the balance sheet, and looking to bolster that up. I certainly expect this company to use that cash to pay down debt over the next little while. So from the financials over at Starbucks, it actually doesn't look all too bad. I think once they can anticipate and once they can get back to revenue growth, I think the costs will remain in check relatively well, as you only saw a 4% increase in costs in the most recent quarter. So once you can get that top line growth somewhere in the mid to high single digit, I think you can once again get back to operating income growth, operating margin expansion closer to, say, call it 20% on the operating margin side. And then that will allow this company to generate pretty decent amounts of free cash flow that they can use to pay down that debt and continue with buybacks and continue increasing that dividend. So that allows this company to be a long-term buy and hold. We took a look at Boeing and they really don't have a dividend, they don't have a buyback, they don't have really any free cash flow. And so that makes it tough to buy and hold a company like that. But with Starbucks, you have some of those things still in place. They just need to figure out the revenue growth. And once that is figured out, I think the rest of the pieces in the puzzle fall into place for this company. Now, from a technical perspective, you do have some things to like over at Starbucks. You have a pretty solid uptrend over the past, call it decade, dating back to March of 2014, as you are still making higher highs and higher lows. So you could make a case that this company still is an uptrend and look to buy the dip within that uptrend. From a valuation perspective, at the current time, you are, I'd say, fairly valued, close to 32 times a forward earnings multiple. And so even from that perspective, I think if you can get a pullback close to 10% down to this $90 range, that's actually a point where stepping into shares of Starbucks would make a lot of sense, not just from this technical perspective, because you have some support here, but also from a fundamental perspective with the valuation coming down a little bit. You have some upper head resistance, say close to this $107, $105 range. So you could maybe look to be a bit more patient, wait for shares to come back lower down to $90 and pick up shares at that point and play the uptrend back up to this $107, $106 range. That's really what I would do with shares of Starbucks. At this $100 range, you could maybe nibble if you really wanted to. I would be a bit more patient, and certainly if you are investing in shares of Starbucks at the current time, just realize that you still have to wait, I'd say 3 to 4 quarters before seeing any meaningful uptick in revenues, and especially any meaningful uptick in earnings per share growth. So the turnaround certainly will take time. I think you have a better chance of a turnaround over at Starbucks though than you do over at Boeing. There's just too many reasons to avoid Boeing, and it's simply too unpredictable. With Starbucks, you do have the dividend, you still have the buyback, and you still are at least producing positive free cash flow. So that was my take on both the Boeing company and Starbucks. Both these companies having underperformed pretty significantly over the past 5 years. I think there is maybe a case for Starbucks at least to begin outperforming over maybe the next 2 or 3 year span. For Boeing, I'd still say there's a lot for them to prove, and there's enough other opportunities out there where you're probably better off putting your money than in Boeing stock. Let me know your thoughts on both of these companies in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.